Buying a depreciating asset on credit means signing a binding contract to sell your future labor. When you finance a new car, you agree to wake up early on a cold Monday morning 3 years from now, to work a job you might not like, to pay for a vehicle that is steadily becoming worthless. Retailers figured out decades ago that focusing on the total price of an item scared buyers away, so the retail systems were completely re-engineered. They stopped asking how much a product costs and started asking how much you can afford per month. By stretching out the term of the loan to 60, 72, or even 84 months, lenders artificially shrink that monthly payment. They make the immediate math look easy to swallow while quietly tying you to years of compounding interest. This engineered system pushes ordinary people into two opposing extremes. Some folks are completely terrified of debt, treating a single borrowed dollar as a moral failing. Others become entirely overwhelmed by it, using credit to finance a lifestyle their income cannot support. But people who actually build wealth look at borrowing differently. They view debt exactly like a chainsaw. It is an entirely neutral tool. If used recklessly, you will face an absolute disaster. If you respect its power and apply it to a very specific job, it becomes incredibly efficient. To harness that efficiency, we are going to walk through a 5-step protocol. This is a practical framework to audit your liabilities, eliminate the ones keeping you broke, and set up a mathematically safe strategy for leverage. Learning to separate the debt that destroys from the debt that builds is the only way to stop handing your paycheck to a bank and start buying back your personal autonomy. Step 1 is the chainsaw audit. You have to lay out your tools. Stop what you are doing and list out every single active obligation you owe. Once you have your list, identify the destructive debt. This is any money you borrowed to consume. It is the high-interest loan you took out to buy designer clothes, a vacation, or something shiny that actively goes down in value the second you take it home. Next, mark your productive debt. This is leverage used strictly to acquire an asset that generates cash flow or securely holds its long-term value, like a sensible mortgage on a modest home. Do not label a heavily financed brand new car as productive debt just because you need to drive to work. You are still paying interest on an asset that is sinking in value. That is a liability. Step 2 is stopping the bleed. Find the obligation with the highest interest rate. This is usually a credit card, and it represents your impatience tax, the financial penalty you pay for refusing to wait until you actually earned the money to make a purchase. This chart shows exactly why that high-interest debt is so lethal. Look at this moderate 8% investment return line. Now, watch what happens when we plot a 20% credit card interest rate against it. Even the most sophisticated minds on Wall Street cannot guarantee a 20% return year after year. You cannot out-invest that kind of math. Routing every available dollar to eliminate that high-interest balance is a mathematical requirement. You will never build security while a machine like that runs against you 24 hours a day. Step 3 applies when you are ready to use productive leverage, like a home mortgage. Before signing anything, you must calculate your margin of safety. This diagram illustrates a bridge built to carry a steady stream of 10,000-pound trucks. The engineers do not build it to hold exactly 10,000 pounds. They build it to withstand 50,000. That massive gap between the expected load and the breaking point is the margin of safety. When you go to a bank to buy a house, they give you a pre-approval number. They tell you your maximum monthly payment is $4,000. That number is not a safe budget. It is your absolute mathematical breaking point. Your job is to intentionally step back from that cliff. You choose a house that only requires a $2,000 payment. You deliberately create a wide, permanent gap between your income and your fixed obligations. Keep your fixed debt obligations to a conservative fraction of your take-home pay. This guarantees you have the breathing room required to build a thick cushion of unspent cash sitting in a secure account. Real life guarantees that a water heater will break or a transmission will fail. If you are leveraged to your absolute limit, that event is a financial crisis. If you have a wide margin of safety and cash reserves, it is merely a mild inconvenience. In the game of wealth building, survival matters infinitely more than speed. Your financial structure must ensure that a temporary job loss or a mild recession will never force you to sell your assets in a panic. Step 4 is the inflation lock. Even with an affordable payment today, you have to make sure it remains affordable decades from now. The structure of the loan is equally as important as the price. To structure your debt safely, you must account for inflation. Over long stretches of time, the purchasing power of paper money steadily erodes. A dollar simply buys less tomorrow than it does today. This chart shows the hidden power of a 30-year fixed-rate mortgage. Notice the flat line representing your monthly payment. As the broader value of a dollar drops over the decades, your payment stays exactly the same. You are locking in the cost of an asset today and repaying the obligation using future dollars that are worth a little bit less. This invisible tailwind only works if your rate is locked. You must avoid adjustable rate mortgages, floating rate consumer loans, or any obligation where the payment can suddenly jump. When interest rates rise, the bank protects itself first. A variable rate allows the lender to change the rules on you after the fact. Your carefully planned margin of safety evaporates overnight, turning a stable household into one that feels entirely cornered. Productive borrowing removes uncertainty. If your family depends on interest rates staying low and the economy remaining perfectly friendly just to keep your head above water, your debt is built on hope. Hope is a terrible financing strategy. The final step is the sleep test. Spreadsheets and interest calculations matter, but borrowing is primarily a psychological issue. It carries heavy emotional weight. Debt sits quietly in the background of every conversation you have. Heavy obligations create a constant, low-grade fear that erodes your patience with your family and dictates how you react to minor inconveniences. It strips away your autonomy. People living at the edge of their financial limits endure toxic work environments, entirely paralyzed, because missing a single paycheck would immediately trigger panic at home. You pass the sleep test when you eliminate destructive debt, keep your fixed obligations modest, and build a thick, boring cash cushion. That combination grants you a steady emotional baseline, regardless of what happens in the broader economy. Start today. Take that single highest interest debt you identified in Step 2 and immediately double the minimum payment. Direct every spare resource toward turning that machine off. True wealth is measured by how much of your life still belongs to you. By deploying debt carefully and insisting on an unshakable margin of safety, you stop paying interest to someone else, and you finally force time to work for you.